Well, we have seen when there is rapid moves in any particular asset classes, especially in areas like what we saw with the gilts and what we see with the FX market, there is always, something that you have to be concerned about, who has exposure and who's going to actually end up looking at it.
It goes back to, sort of these issue of what policymakers are doing, whether it's fiscal and monetary, or in some cases over there both. To the debate on whether the Fed's doing too much, whether the Fed has caused a lot of this volatility on both markets, bonds and stocks. What's your answer to that, do you think?
Well, the answer is that it takes, between 8 months and 12 months for the monetary policy impact to actually see it in the real economy. Now, what we see the early signs already is that we see yields up. Even before the UK, we already saw that the 10-year yield was reaching, all-time highs.
Yeah, I'm looking at it right here. I said almost 4%. I wouldn't be surprised by we're having the conversation. It goes to 4%. You never know.
We see that the yield curve is inverted at very high levels already. We actually see, significant amount of those implications already embedded into the markets. Now, what we have not seen is that embedded into the economy. And I think not until then we're going to see the real impact of what the Fed is doing now. The bigger question mark is the pace of what they're doing it without necessarily taking a pause. It's certainly created more uncertainty in these markets and creating that level of volatility we're seeing out there.
I mean, I hear you saying, yes, I think they're doing too much because they have not allowed this lag effect to come to fruition, to at least see what the ramifications are of what they've done. Is that a fair characterization of your point of view?
I think the point of view has to do with if the whole concept of, reducing inflation, it is as far as a function of labor market, it is going to be a really long way before they can, commit to slowing down. Obviously, the labor market is pretty tight, and that's a source of inflation, mostly demand-driven inflation. Mm-hmm. And as long as we have a tight level market, and that's the message or the signal that the officials will look for continue the rising rates, it is going to be a very difficult piece to actually overcome.
Do bonds continue to get cheaper and become more and more attractive?
Well, that's actually a great question. The interesting thing about this is that if you actually think about what we were just talking about earlier, the volatility in fixed income relative to the volatility in equities, this year, the equity risk premium has actually come down as opposed to go up like what you would expect now. What that means is that equities look cheaper relative to bonds, even with these, higher levels of yields, just because the changes have been so dramatically fast.
It's great to have you back. We'll see you soon.
Good to see you.
That's Schwab's Omar Aguilar joining us here, Post 9.